Financial experts used to think that long-term portfolio performance is 90% asset allocation and 10% timing and selection. But recent studies have shown that investor behavior can actually account for up to 50% of long-term performance. And unfortunately, that's one of the biggest risks in portfolio management. One of the most common mistakes that clients make is letting the media be their advisors. We live in an information age, so it's only natural for clients to feel anxious when they're bombarded with bad news every day. The media is very good at stirring fear among investors, but if you base an investment decision on what you see in the media, you might find yourself selling out of panic when the market goes down, or just rushing in to buy out of fear of missing out when the market goes up. It's important to keep yourself informed, but we need to make an investment decision based on facts, not emotions. We don't always make the best decisions when we panic or when we are worried about missing out. As an advisor, I like to have a crystal ball in my hand so I can tell clients when exactly the market will go up or down. But in real life, most attempts to try to time the market, even by experts, are not particularly helpful in managing long-term performance. So we would rather focus on long-term gains rather than short-term wins. We're talking about an investment horizon of 10, 20, or even 30 years. So as long as we have sufficient liquidity in our portfolio and quality assets, we are not so concerned with the day-to-day fluctuations. Well, the peer pressure or the fear of missing out might distract you from the fundamental principles of investing. For example, back in 2015, when California was experiencing the worst drought ever, we saw a surge in walnut prices. In less than 12 months, the share price went from $5 to $12, only to see it come crashing back down to below $5 9 months later when the drought broke. We don't need an investment to go up in value by 20% overnight. We just need it to be there in 20 years' time. We can't drive a car by looking at the rearview mirror alone, and the same goes with investing. We can't ignore past performance, but we need to see beyond the simple numbers and really ask ourselves, what was driving the good performance? What is likely to drive future performance? How well does that investment fit in my portfolio? The most common way for people to lose money is to sell out of panic. You're more likely to make an irrational decision when you panic, and you might be selling an already oversold asset below its fair value. Another way to lose money is for people to sell out of lack of liquidity. For that reason, our investment philosophy emphasizes on having at least 4 years of your income requirement in non-market linked assets so that you won't be forced to sell when the market goes down. You're more vulnerable to losing money when you put all your eggs in one basket. A well-diversified portfolio will smooth out the individual company risks across the whole portfolio. Having said that, you don't want to over-diversify either. You need to have a good discussion with your financial advisor to reach an optimal level of diversification for your portfolio.